Maverick traders, welcome out to your market roundup for January 3rd, 2023. We have kickstarted a new year, today being the first trading day, and basically a sideways day today. Not much happening, but that will change here, certainly. And let's get to 2023. So, as the year kicks off, we started with a little bit of a gap higher, and then it pretty much sold off right from the start. We finished slightly lower across most major markets. You can see the Dow, the S&P kind of flattish, the Russell. Oil was down a little bit more severely, and then gold up about 1%, the only thing in the green. But it's a little bit misleading. And why do I say that? Well, there were actually 52% of stocks advancing. So it was basically flat, but actually more stocks were going up. So how did the markets go down? Well, the bigger names, the most important, impactful stocks were the ones falling. The 50 period moving average shows that we're in somewhat of a sideways range right now. It's tilted a little bearish with 60% of stocks trading below their 50-day moving average. On the daily news, as we said, it's the big names that are pulling the markets down, that are holding them back. If you go back over the past couple of weeks, most stocks are up, but the indexes have stayed sideways. And that's because Apple and Tesla and these companies are in free falls. Apple falling below 2 trillion market cap. Amazon has been down. Google's been down. Microsoft has been down. These are the biggest market cap weighted stocks. Tesla fell today again, and Tesla's, speaking of free fall, I mean, that thing is just getting blasted day after day. It fell sharply lower today on delivery numbers that came in a little bit lower than anticipated. Just people losing their appetite for Tesla, not liking that Elon Musk is putting so much attention into Twitter and so on. As we look at the markets, a couple of weeks ago when I did the market roundup, I highlighted an idea that I thought we would kind of bottom in here and push higher. And the reasoning behind that is really that I feel like this was the first big wave down. And then this was the second wave back up. And this was the third wave down. And this was the fourth wave back up, right? And this was the fifth and final wave. And then what you normally do after that is ABC correct. And where does the ABC correction usually go to? To about the fourth wave. And in addition to that, so I kind of see this as an A, B, C style correction. And that certainly could still be in place. In fact, we're up a little bit from where we were a couple of weeks ago. Today was higher, and then we kind of fell back. I would call it flat, kind of sideways for the past couple of weeks. More stocks have gone up over the past couple of weeks than down, but the index has been sideways. Can we still get up and through that trend line? This downtrend line would be a key level because so many people are trading against it, right? Saying as long as we stay below that, I feel confident, I feel comfortable. It could try to push up above that and have a correction. And then the bear market may well resume thereafter, but that's kind of been my thesis, is that the next stop, it would make sense to me, is maybe a push up here. Now, it's entirely possible that we're just going to fall from here and come down and take out these lows and so forth and really stumble out of the gates. There are some problems with that thesis for me. One being, it's pretty rare to just start the year down and just continue to go down from day one. We did it in 2022. The likelihood that we're going to do that again in 2023, the market's never going to have an upward push. I mean, I guess you could say we could fall early and then rebound late and so on. But everyone's so pessimistic and thinking we're going to decline in the first quarter. It makes more sense to me that we would actually advance, kind of confound people, show some positive returns early, and then proceed to fall later on. I think this is going to be a drawn out process. I don't think we have a quick recovery. I think the Fed has to keep rates up for an extended period of time. There's just some changes that have happened in the market that are going to take time to filter through. So the idea that there's just going to be a lot of pain early on and then we're going to have some big recovery, not likely. I kind of think we're actually in the better spot for markets to advance a little bit where people are so pessimistic. If you follow things like put to call ratios, we're hitting record numbers because so many puts are being bought and so on. That's a sentiment gauge. That basically tells you everyone is bearish. Everyone is expecting a big decline. Now, maybe we just keep going sideways. That wipes out the puts, right? That causes them to inflict pain on those put buyers. But when you're buying record amounts of puts, it actually is less bearish. People are insured, people are protected, they're less likely to be forced to liquidate and so on. So if the large cap names can just stop their declines, we would actually be advancing higher in the markets. Here you can see the NASDAQ, and it's not pretty. I mean, we're down here potentially on the cusp of breaking down, and the NASDAQ is within a whisper of it wouldn't take much to make a new low. The S&P would have to go down a lot to go down and break its October low. The NASDAQ, a couple of bad weeks, a couple of bad days really, and we're making new lows. So you can see that the relative weakness is in the NASDAQ and in the tech names, and specifically mega cap tech. So as we kind of look at our heat map, it tells a pretty compelling story. Apple has been a huge drag on the market, and again today. Tesla has been a drag on the market, and it was again today. Barring, except for those two, really the only pain was in energy. And energy makes perfect sense. This was something that I talked about, that the January effect is when something has been up really, really strongly, and energy was the only thing really that was booming in 2022. It usually starts the year really rough because people are delaying their sells of energy stocks. They don't want to sell their energy stocks that are up a lot because it would trigger a tax bill. If they wait until the calendar flips over and then sell their energy stocks, now they get to delay that tax bill a whole extra year. And so were people waiting but wanted to take some money off in energy? It certainly seems that way. That is January effect type of play right there, where energy just got smacked upside the head. And that's not a huge surprise. When something is up big, put this in your notes, watch for it year after year. Whatever sector is up strongly, and energy was up 55% for the year or whatever it was, that's one that is ripe for January effect, where as soon as the calendar flips over, there might be a lot of selling in that sector, and that's not uncommon at all. So our weekly outlook, I mean, if you're just looking at this on a shorter term basis, and saying, where are we at? Well, we are below the 20, we are below the 50, we are below the downtrend line. It's been a sideways market, but I can't in good conscience kind of say that we're off to the races. I think you have to kind of play the pivots here. I'd feel pretty optimistic about that thesis if we can push up above today's highs and so on, start to climb back up towards that trend line, and I think you're going to zip right up through there. If we start to roll over, though, like I said with the NASDAQ and so on, if they just continue to weigh on the markets, maybe it doesn't play out the way I expected. I still would lean that way, though, that I think there's going to be a move up above the downtrend line before this thing's all said and done. Perhaps most importantly, of course, is, well, what are you going to trade during that? And let's highlight a few different bull and bear names. On the bullish side, I'm going to start with ABC. This is a healthcare related name. And you can see the prior breakout zone back here, this general area around 165. When I talk about support and resistance, I don't think of it as a hard cement-like area. I call it a cushion, right? I kind of think of it as a trampoline. When you land on a trampoline, you squish down and then it zooms you back up. We're squishing into support right here in kind of an A, B, C style correction. See that 1, 2, 3 pattern? That's how corrections normally look and feel. Today we had a hammer candle, which is buyers bought this stock off of the lows. These hammer-like candles are often low points and trigger some buying thereafter. Look at the long lower shadows and then the buying that follows. And so, this would be one of those. That's a hammer that should see some follow-through buying. ABC, easy as 1, 2, 3. I would kind of look at that as a bullish candidate here. Deer, So again, kind of looking at this big picture, you have resistance up here in this general area. You have a huge decline that fell off and a big recovery. And when you first got back to that resistance, notice how we responded. It was a key level from the past. We went up to it, struggled. We've since fallen off of that, creating this little handle type of effect. So you have kind of the cup and handle pattern. Notice that the selling is not severe. Notice that there's not like massive volume and big deterioration and so on. It's just kind of a walk back to support. It's, a lousy month of just kind of back and fill and choppiness and so on. That's nothing that should trigger any major concern in any way. And as you kind of look at this, the expectation would be that we should start to work our way back up and eventually through that resistance zone. So this should act as basically the bottom of the range. And you can kind of trade against that 420 level. Tesla I have on the bullish list, and that seems absurd. But I would trade this only with limited risk and quick exits. And let me highlight kind of the thesis here. You can see the volume a little bit behind the candle. I should have separated those. But today had the highest volume we've seen on this chart. If you were to go back and look at all the volume spikes, today was the highest. This thing has been in free fall, and what normally happens in kind of a plunge like this is that you'll see, essentially think of it as somebody's arm being twisted until they yell uncle and they've had too much. And that's what that volume should look like. I would play this if, imagine tomorrow there's a big gap down, a huge sell-off, and the volume spikes even further, and then we come off of the lows. So I've got certain things that I've got to see here. I've got to kind of see a hammer-like candle. I've got to come off the lows. And then even then, I would play it only for a bounce back for a few days and be out of it. It's a quick thesis. It's just kind of an exhaustion setup. Normally, you'll spike back initially and then kind of consolidate and then maybe travel higher after a consolidation. But I won't even be in it that long. So I don't play a lot of exhaustions, but Tesla's getting to that point where it could really flush. If the volume explodes, I think the volume today was over 250 million shares. Well, we can see it here. There's the 250 million mark, and I think we eclipsed that by a little bit, or we're pretty close to it. Let me at least say that. And I would look for something in excess of that. You'd want to see full capitulation, maybe a 300 million share day where the volume is just head and shoulders above the others, and you get that long lower shadow type candle. That's where you start to feel like a temporary bottom is in, and it's tradable. It's high risk, it's counter trend. It's not something I highlight a lot, but maybe an interesting idea. Don't risk too much on that, because it is catching a falling knife, as they say, and sometimes it'll slice you up. But if you get all those pieces, all that criteria, it should be good for a bounce. And if not, take a small loss and exit the trade. IYR, I have this one on the bear list, and basically it's kind of a dividing line here between 85. We're currently at 85. This is commercial real estate. Wouldn't be my favorite sector for the year, and I think we could see another decline. We've kind of broken below, coming up to underneath that, the little kiss goodbye potentially for another push to the downside. Snowflake. This has been consolidating, and I'm really going to call the consolidation like this, the descending triangle. Today was just very ugly. Huge bearish engulfing formation. Started on the highs, finished on the lows. Looks like we're going to plunge below that support, at least temporarily. And again, it's kind of like Tesla, but in reverse, this one being bearish. Tesla is a possible bullish idea. Just understand the volatility you're trading in Snowflake can be very, very high. So either put on a very low risk, kind of low cost spread that you position size for max loss, or if you're buying something that's more expensive, and a lot of times the options are more expensive on a high vol stock, accordingly, you want to risk less. So you're in it for a couple of days. If it's not working within a day or two, you rip the band-aid, you just take your medicine and move on. Wells Fargo, last but not least, kind of an inverse cup and handle here. We plunged down to this level of support. We plunged down to retest it. That's the big inverse cup. And now we've bounced. That should be the handle. And if you do the math on a cup and handle, you can see that 40 is the bottom, 48 is the top. That's an 8-point range. 30% of 8, so the handle's usually about 30% the size of the cup. 30% of $8 is 240. 240 from here would put us at 42.40, and that's pretty darn close to today's high, which was 42.13. This is basically where it should be stalling out, in this area and trading right back down to 40, and quite possibly, quite probably below 40 temporarily. So Wells Fargo is a potential bearish candidate, kind of an inverse cup and handle pattern there. Markets are still in a bear market, and we can't lose sight of that. I think we are if there's anything that we've certainly been in, it's a choppy environment. There hasn't been a clear cut last couple of weeks. There's not a clear green, buy everything, a clear red, sell everything. It's just not that way. We're just going back and forth. We're spinning our wheels. Certain areas of the market are weak, certain areas are strong. There should be a resolution to that coming up soon. So it was bound to get a little choppy into year end. We kind of talked about that for some time. I would still lean towards thinking we're not done with this correction, that there's one more push to the upside that'll really wipe out the negativity, the pessimism. The sentiment just got too negative in my view. Maybe that doesn't happen, but that would be my thesis, that I would still think plays out, that push above the downtrend line, and then we'll see from there. That might be the mother of all sell signals and short setups, but we'll cross that bridge when we get there. Economic reports, Fed minutes on Wednesday, payrolls on Friday. Not much happening in earnings, but earnings really kick off next week. So we're big on earnings in January, April. These are the key months for earnings, and we're in January, so earnings season starts in about a week. For this week, Constellation, Walgreens, nothing too major happening there. Hope you enjoyed the market roundup today. Happy New Year, everyone. Great to be with you again. On behalf of Maverick, I'm Corey Halliday, and we will see you next time. Goodbye, everyone.